Good morning, students. Welcome back to the session on advanced accounting. Today we will continue with our discussion on AS 20. In the last session, we touched upon certain concepts related to AS 20, and we'll just do a quick recap in terms of this EPS. This standard requires this EPS to be computed, that means earning per share, and there is no recognition or measurement criteria in this standard. It's only about the presentation in the P&L, or you can say the disclosure requirements which have been covered under this standard. Now, what is this EPS? EPS means the earning per share, which is computed by using the formula wherein we compute first of all net profit or loss which is attributable to the equity shareholders, and which is then divided by the weighted average number of equity shares outstanding during the year. Herein, for the purposes of this net profit or loss, we don't go by the profit which is given as per the P&L. From that profit, we are required to reduce the taxes as well as the preference dividend in case there are preference shareholders. But for the purposes of this weighted average, which is required to be computed, many adjustments may arise, and that will depend on the situation that we are going to have. For example, if the number of shares will change during the year, then of course this weighted average will change. If the number of shares remains same throughout the year, then this weighted average will also remain same. We discussed one adjustment related to bonus issue while computing the weighted average number of shares. And this particular adjustment related to bonus issue was because even though the bonus issue will come at any point of time during the year, but still this will be required to be computed in the weighted average, to be covered in the weighted average from the very beginning of the year. Yeah, and this will also require restatement of the previous year EPS computation by considering this bonus issue in the previous year also. Correct? Yeah. Now moving further, other than bonus issue, there is also a type of arrangement that we may have to consider while computing the weighted average, that happens to be in relation to rights issue. Yeah, right issue for the shares. And if you want, you can refer to page number 1.103. Now, what is this right issue? Right issue is somewhat similar to the bonus issue, because right issue is also given to the existing shareholders first of all. Means whenever any company wants to come up with an issue, what would it do? It would go to the existing shareholders first of all. Okay, so this goes to the existing shareholders. Existing shareholders first. Further, in relation to the price, here again, this issue is not offered at the market price to the existing shareholders. This will be offered at a discount, you can say. Means if the market price of the share is rupees 40, then this issue will also be given at rupees 25. But unlike bonus issue, herein some price is charged from the shareholders. So this is offered below market price. Okay, that's the other understanding which we need to consider over here. Now, here again, because the right issue comes up with this type of arrangement of below market price, we may also say that right issue has got some element of bonus issue. Now let's understand what is the some element of bonus issue. Let's suppose market price of the share is rupees 100. Okay. And the company has come up with the right issue. Now, if the company wants to come up with the right issue, what should they do? They should reduce this market, they should reduce the offer price to the existing shareholders. Now, if let's suppose right issue was not given, if the company doesn't come up with right issue, so what would the company do? Company would offer the shares at the market price, correct? But in case of right issue, offer price, in case of right issue, let's suppose has been kept as rupees 50. Okay. Now, in case the company has come up with a right issue, and let's suppose to an existing shareholder, 2 shares have been issued. To an existing shareholder, or you can say to every existing shareholder, 2 shares have been issued. Okay, yeah, 2 shares each. Now, in this case, there are 2 ways to look at the right issue. Either we can say 2 shares have been issued at rupees 50, and we can also see this arrangement or this offer in some other manner. Let's understand this. We can also say here that out of these 2 shares, in a way, 1 share has gone out at the rate market price. 1 share has gone out at the market price, and the other share, second share, has gone out free of cost. It will be one and the same thing. It will be one and the same thing if we say this. Yes or no? Because 2 shares which have been offered to the shareholder will give you 100 rupees. Correct? If you are the company. In other words, we can also say that the company will get 100 rupees from 1 share and nothing from the second share. In a way. This is not the arrangement which happens in case of right issue. But I'm saying in a way we can also say that right issue has got some color, or a part of the right issue is nothing but the bonus issue. Now in this case it was 50-50. In this case 50% was at market price, 50% was free of cost. So that's why in this case we can say that the bonus issue has got 50% element of bonus issue, but in some cases it may be 25%, in some cases it may be 75%, in some cases it may be 30%. It may vary depending on the pricing which will be kept. Yeah, clear? Now, because of this fact that the bonus shares are also in a way included in the right issue, or you can say some portion of the right issue is exactly similar to the bonus issue. That's why we are required to make similar sort of adjustment which we did in case of bonus issue while computing EPS. Which means whenever we will compute EPS and there will be a right issue during the year, so there again we will have to recompute the weighted average after considering the right issue. Okay, and what is that adjustment that we will be required to do? We will have to check the portion of the right issue which is in the form of bonus issue. That portion will be considered from the beginning of the year, and the portion of the right issue which is equivalent to the market price, that will be considered from the date of issue of right shares. Correct? And similar to the bonus issue, this adjustment will also be made in the previous year, and the EPS of last year will be recomputed. We'll have to restate the EPS. Yeah, exactly similar to the one which we did in case of bonus issue. But the only thing is, in this case, entire portion of the right issue is not the bonus issue. Some proportion of the right issue is the bonus issue. Some proportion. Now that proportion will have to be computed every day. Yeah? You understood this? So this is the proportion of right issue which contains bonus issue. Yeah, in a way, we can say that this is the part of the right issue which contains the bonus issue. Now, for the purposes of computing this weighted average, we will have to compute this proportion every time there is a right issue, and that proportion will have to be considered while computing the weighted average. So now let's understand how do we compute this proportion. For computing this proportion, there is a formula. Let's understand this formula. Okay, as we discussed, only for the purposes of computing this proportion, this formula is required to be considered. Fair value per share immediately before exercise of right divided by theoretical X rights fair value per share. Now let's understand this formula. Now what do you mean by this one? Now we have understood one thing. Why is this formula required? This formula is nothing but a proportion of the bonus issue which is there in the right issue, because this will be used for computing the weighted average. Now let's understand how does it help us. Let's suppose company had 10 shares. Company had 10 shares of rupees 10 each. 10 shares of rupees 10 each. So what was the amount? 100 was the amount. And the company issued 2 shares. Let me just make it 100. So this becomes 1000. Company had 10 shares of rupees 100 each. So this was rupees 1000. Now what is this 100? This 100 is the fair value per share. Fair value per share immediately before exercise of right. Company had 10 shares and every share had a fair value of rupees 100. So that's why the value in totality became 1000. Now, company issued 2 shares. This was right issue. So company came up with right issue and issued 2 shares. These shares were issued at 60. So what is the amount? 120. Now, after right issue, let's understand what is the position. After right issue, what is the position? Number of shares become 12. And the total value becomes 1120. Total value becomes 1120. Now, let's understand this theoretical X right fair value per share. Okay, now I am talking about only this part. Now, what is theoretical X right fair value per share? That is, let's understand how do we compute it. That is fair value of shares immediately prior to exercise of right. What is the fair value of shares immediately prior to exercise of right? 1000. Plus total amount which is received from right, 120. So that means 1120 divided by 1120 divided by number of shares before exercise of right and number of shares exercised in right. Well, so what do we get? Yeah, let's compute this. What do we get? 1120 divided by 12. So we get 93.33. Okay. Yeah. Now what do we call this value as? This is the denominator. This is theoretical X right fair value per share. And for the purposes of proportion that we are required to use, what will be that proportion? Fair value per share immediately before exercise of right. What was that? 100. So our proportion for the purposes of computing weighted average will be 100 divided by 93.33. Okay. Now this is the proportion that we will use for the purposes of computing the weighted average, which will be used in the denominator. Yeah. Clear? We will get more clarity around it when we will solve one illustration. But before we get on to this illustration, please remember that there are 2 ways. Either you can just mug up this formula, which is given. And how do we compute this? This is again given. So you can just refer study material. You will also understand the formula to compute this. But the better way is to understand as to how this is computed. In that manner, you will be better able to remember this for a long period of time. Okay. So let's move on to illustration number 4 now on page number 1.100. Once we solve this, we'll get more clarity. Net profit for the years. X1 is given, X2 is given. Number of shares outstanding prior to right issue is given 5 lakh. Right issue price is rupees 15. Last date to exercise the right is 1st March X2. So what do we find? We have 2000 X1, 2000 X2. And once again, we find this to be a calendar year. Yeah. On 1st of March X2, over here, we can say there is right issue. Correct? This is the last day to exercise right. Right issue is one. In case of right issue, one new share has been given for each 5 outstanding. That means for 5 lakh shares, 1 lakh shares have been issued. Fair value of one equity share immediately prior to exercise of right on 1st of March X2 was rupees 21. So right issue price is 15, but the fair value per share before exercise of right was rupees 21. You are required to calculate basic earning per share. I think this is quite easy. Can you start solving this on your own? So net profit in this year was 11 lakhs and in the next year it was 15 lakhs. So these are the net profits given to us. This is the date of right issue. And you can also say on this date right issue came at 15. Yeah, I'm hoping you have started solving this. Okay, so in this case, first thing which is required to be done is what? Computation of the proportion which will be used for computing the weighted average. So that's the first thing we are required to compute. And for that proportion, what do we need? Theoretical X right fair value per share. Correct? Yeah. So now, before the exercise of right, how many shares do we have? 5 lakh. At the rate rupees 21. So this is the value which we have before exercise of right. Or let me just put it in the same manner the way we did it in our example. At the rate 21. Correct? And from the right issue, wherein 1 lakh shares have been issued, 15 rupees would have come. Okay, now what is the value? So now, can you just keep sharing these values? So prior to exercise of right, it was 5 lakh into 21. So this was 10.5 million. Yeah. And from the right issue, it's 1 lakh into 15, 15 lakh. Okay. So after right issue, what is the number that we have? 6 lakhs. And the total value will be 1 crore 5 lakh, 1 crore 5 lakh plus 15 lakh. So this becomes 1 crore 20 lakh. Okay, yeah. So now theoretical X right fair value per share will be what? This divided by this. So it will be 1.2 crore divided by 6 lakhs. So what do we get? 20. Correct? Now this 20 is what? Theoretical X right fair value per share. And what is the proportion which is required to be used for adjustment? That proportion will be fair value per share immediately before exercise of right. What was it? 21 divided by theoretical X right fair value per share 20. So that means this is the proportion we are required to use. Okay, we can also say this is 1.05. Either you can keep it in fraction or you can just keep it in numbers. Now, we will compute the EPS. So first thing will be to compute the EPS for the current year. So we have 2 years, X2 and X1. Okay. Now for the current year, what is the net profit? 15 lakhs. And last year it was 11 lakh. Now do we need to make any adjustment in the net profit? No, there is no preference to it. So that means this is final. This is final. Okay, our numerator is clear. Now the only thing that we need to work on is what? Denominator. Weighted average number of equity shares is what we need to compute. Correct? So now we understand that this right issue came on 1st of March. Prior to the right issue, how many shares did we have? 5 lakh. So 5 lakh shares were there, in which we will make the adjustment into 1.05 for how many months? 2 months. Okay, for 2 months. Why? Because after that, the right issue has actually come. Yeah. To this, we will add the revised number of shares. From 1st March, the number of shares became 6 lakh. And after 1st March, do we need to make any adjustment? No, because right issue is already included in this. So we'll simply compute this for 10 months. We'll simply compute this for 10 months. So what does this number become? 5,87,005. Okay. And in the last year, what do we do? In the last year, we understand there were 5 lakh shares to which we will apply this adjustment. And now this adjustment will be applied for whole year. Into 12 divided by 12. So what do we get? Last year, because we have to recompute the EPS, so we'll have to make the adjustment in the last year also. So this becomes 5,25,000. Okay, so this is the number that we have for last year. Now, for the purposes of EPS, I think the remaining part becomes very easy. Why? Because this is A and this is B. So what do we need to do? Simply A divided by B. So what do we get? 15 lakhs divided by 5,87,500. This becomes 2.55. This becomes 2.55. Correct? And for the last year, what does it become? 2.10. 2.10. And this EPS of the last year, which we have computed, is what? Restated. Or you can say adjusted. You can call it by either name. Either you can say it's restated or you can say it's adjusted. Okay. Okay. Yeah. And please remember, you will have to also show the previous EPS, means the original EPS for the last year. And how do we compute that? Very simple, 11 lakh divided by 5 lakh. 11 lakh divided by 5 lakh, that will be the original EPS. This is the restated EPS. You should also show the original EPS in your solution. Clear on this? Now, any questions, any doubts that you may have? Sandeep has solved this. Very good. Vandana, Sandeep, I think all of you have computed this adjustment factor. Pooja, then Sandeep has also shared the computation. Vandana has also shared the computation. That's good. And I'm hoping this final solution has also been. Yeah, so for you have got the final solution also. Yes. Any questions that you may have on this? Okay, so we are done with this. Then I can see Adit has some query. Yes, Adit. Sharon is asking for the weighted average. See, weighted average is very simple. To the number of shares which you have prior to the issue of right, you just need to simply apply the proportion. Proportion that we have computed, you can say this adjustment factor. And then of course the time weight which we have been using. Sanchita is asking for the revision. Yes, once we are done with the standard, then we'll revise it. Okay. Adit is asking, sir, why we are multiplying 1.05 with 5 lakhs? Because this 5 lakhs is what? This 5 lakh is the number of shares before exercise of right. On 1st of March, right issue has come. Okay. Prior to this, during this period, what was the number of shares? 5 lakh. After 1st March, the number of shares has become 6 lakhs. Okay. During this period, after 1st March, the number of shares became 6 lakhs. Correct? If this was not a right issue, but a normal issue, then we would have considered this 5 lakh for 2 months plus 6 lakhs for 12 months. Yeah, yes or no? We would have assigned weight, and this is how we would have computed weighted average. But this issue was the right issue. And what do we say? We say that whenever right issue comes, it has got some bonus element. And whenever there is a bonus element, what did you do? You consider the bonus element not from this date. Currently, 1 lakh has been considered from which date? 1st March. Instead, what do? You consider the bonus element from the first day of the year. Yeah. Now, because this has got some proportion, entire amount is not the bonus issue. Some portion is the bonus issue. So that's why you compute that proportion. In our example, what was that proportion? 1.05. Or you can say 5 lakhs into 1.05. This is the number of the shares which now includes the bonus issue, which we consider only for 2 months. After that, we consider the total number of shares. That's why we are making this adjustment. Okay. Yeah. Now Charu has a query. Charu is saying, but sir, why we are not considering it in 6 lakhs? Because in 6 lakhs, we have considered the entire right issue. 6 lakhs comprises of 5 lakhs plus 1 lakh right issue in totality. So that's why we will not recompute this. It's fully included. But in this amount, in this number of shares, nothing was included. We were required to make some adjustment. That's why it's not done. Now clear? Kushi is asking EPS for X2 again. EPS for X2 is then simple. Profit for X2 is available to you. 15 lakhs divided by the weighted average. Very simple. Sharon is clear on this now. Meman, yes, you will get the presentations. I think some of the presentations are already uploaded. From there, you will get some of the notes. Otherwise, you can also keep noting down all of these things that we have been discussing in the session. Okay. So, Adit, Charu, are you now clear on this? Shraddha, I'm hoping you're clear on this now. Quickly, please confirm. Okay, Pooja is clear. Charu is also clear on this. Great. So we'll now move further on to the next part of the standard, which is about diluted earning per share. Diluted EPS, which is also called as DPS. So far, EPS that we had computed was called as basic earning per share, BPS. And as we discussed that whenever we are talking about EPS, that means basic earning per share. Means if nothing is specified, what do we assume? We will assume that the EPS is basic earning per share. But EPS is not the basic earning per share always. It could also be diluted earning per share, but this is something which will be specified. And let's now try to understand what do we mean by diluted earning per share, what is the need for computing this, and how do we disclose it. So let's suppose the basic earning per share for a shareholder is rupees, say 8 per share. So we computed EPS and it came out to be rupees 8 per share. Correct? Now what does it imply? As we discussed, this is the performance indicator for the company, for the period, for the year, wherein investor gets to understand what is it that he has earned by making an investment of rupees of 1 share in the company, which may have a worth of rupees 10. Means investor will get to understand that by making an investment of rupees 10, which is equivalent to 1 share, he has earned rupees 8 per share during the year. Okay, it could be rupees 8 per share, it could be rupees 2 per share. It can vary depending on the profits and other adjustments. So the investor now understands that his EPS is what? Rupees 8 per share. Okay. Now, this EPS also indicates the amount which will be available to the investor. Means out of the company's reserves, this amount belongs to whom? To the investor. This is what the investor understands. Even though this has not been paid, but this belongs to the investor. That's the understanding of the investor, that this much amount belongs to the investor or the shareholder. Correct? But there could be certain type of instruments which are not in the nature of equity shares, but which may have the potential of becoming the equity shares. Let's understand. Say the company also had convertible debentures. the company had convertible debentures. Convertible debentures means those debentures which will not be redeemed, but which will be converted into equity, after some period of time. So eventually what has to happen? These debentures have to become equity. They will get converted into equity shares of the company. Okay. So now, if we look at the time chart, say we are looking at the current year, wherein company has got equity shares, or you can say equity share capital, as well as convertible debentures. Yeah, and the EPS for this year is ₹8. So that's why these equity shareholders are thinking that they have ₹8 belonging to them. Okay, out of the reserves of the company, ₹8 belongs to them. This is their thought. But is this true? The answer may be no. Why? Because even though we see this ₹8 belonging to equity shareholders, there are certain debenture holders. There are certain debenture holders which will also get into the shoes of equity shareholders. Say after 2 years, these debenture holders will also come and get into the shoes of equity shareholders. That's the understanding, because they are convertible. And when they will come and become the equity shareholders of the company, at that point of time, what will happen? At that point of time, when they will come and become the equity shareholders of the company, at that point of time, what will happen? The returns which the equity shareholders are getting today will get diluted. Why? Because they will have to share that return with some more equity shareholders. So whatever is the number of equity shareholders today, that will increase once these convertible debenture holders convert their debentures into equity, or say they get converted into equity shares. Okay. Now, in this scenario, there are two things which are required to be considered by us. Standard says that this change is going to happen after 2 years. This is not happening today. But even today, when you are computing the basic EPS, you should also compute DPS. Now, what does this DPS means? DPS means we need to compute the EPS. Wherein we should assume that these type of potential equity shares, what do we call them? Potential equity shares, should also be considered as equity shareholders. Means even though these instrument holders are not the equity shareholders, but what do we call them? They are called as potential equity shareholders. They are called as potential equity shareholders. So today itself, these potential equity shareholders should be treated as equity shareholders, and accordingly the EPS should be computed. So while we will compute the basic EPS in the same manner the way we have done, in addition to this, we will also compute DPS. And while computing the DPS, we will have to assume as if these potential equity shareholders have become equity shareholders. Now let's suppose if we assume that the convertible debenture holders are not the debenture holders, but they are the equity shareholders today itself, means in this year itself. In this case, two things are going to change. Two things are going to change. First, the profits of the company will increase. Let's understand how. Let's suppose net profit of the company was rupees 1 lakh. Now while computing this profit, interest which is paid to the debenture holders would have been reduced. Interest which is paid to the debenture holders would have been reduced. But in case we assume that these debenture holders are not the debenture holders, but they are the equity shareholders, then in that scenario, do we need to pay interest to the debenture holders? No. So that's why interest will get added over here. And on this interest, we will also have to compute tax. So the interest post-tax. Interest post-tax will have to be computed over here. Correct? So this is the first factor which will change. Profits will definitely increase. Number one. What is going to be the second impact? The denominator means the number of equity shares, or you can say the weighted average number of equity shares outstanding during the year will also increase. Weighted average number of equity shares will also increase. Let's suppose this was 10,000 earlier. Now we will check that what is the conversion rate, means how many shares will be issued to these debenture holders when they convert into equity. Let's suppose they were to get 1,000 shares. So we will consider that 1,000 shares today itself, by which the number of equity shares for the purposes of our denominator will change to 11. Correct? Yeah. So at one place, numerator will change, wherein we are sure that the profits will increase. There is no doubt about it. And in the denominator, we are sure that the number of equity shares will increase. Okay. Now, considering this change, which is going to arise in the numerator as well as the denominator, we will have to compute the DPS. So this new profit, or you can say this revised net profit, after considering this adjustment and this revised weighted average, will be used for computing EPS, and that EPS will be called as DPS. That EPS will be called as DPS, diluted earning per share. Okay, clear? In this case, there are a couple of things you'll have to consider. Earlier, basic EPS was rupees 8. Yeah. And now we will compute the DPS. And now we will compute the DPS. When we compute this DPS, two situations are possible. Either the EPS may go up, say it becomes 8.5, means it may go up from the basic earning per share from the previous EPS, it may go up, or it may also go down, or it may become 7.5. Only two situations are possible. Okay. In case the EPS goes down, is lower than basic earning per share, in such a case, we will call this EPS as diluted earning per share. And why do we call it as diluted earning per share? Because now the EPS has got diluted. Why did it got diluted? It got diluted because some more equity shareholders have joined. They have joined in the pool and they are going to share the profits. The chunk of profits may have increased, but it may not have increased by the same proportion in which the number of shares have increased. Let's suppose earlier the profit was 1 lakh and the number of shares was 1000. So what was the EPS? Say 10,000. So what was the EPS? 10. Say now it becomes 1,10,000 and the number of shares becomes 20,000. So in this case, what will be the EPS? Can you tell me? 11,10,000. Sorry, 1,10,000 divided by 20,000. So what do we get? 5.5. We get 5.5. Now in this case, EPS has gone down. So what do we call this EPS as? DPS. And please understand, why did this happen? This happened because of the fact that even though the profit has increased, but the profit has not increased in the same proportion in which the number of shares have increased. Means the proportion of increase in the number of shares is more as compared to the increase in the profit. Correct? Yeah. But let's suppose this we call as DPS. But let's suppose instead of this type of change, say the change is something like this, that this profit becomes 1,40,000 and the shares become 11,000. Now let's check what is going to be the EPS. 1,40,000 divided by 11,000. Now we find EPS equivalent to 12.72. Now the EPS is 12.72. Okay, and why did this happen? This second situation, why did this happen? Because the profits have increased in significant proportion, or the proportion of increase in profits is significantly more than the increase in the number of equity shares. Correct? Correct? Clear on this? Yeah? Whenever we have a situation wherein the EPS doesn't go down but it goes up, this you will see was going down, but this one goes up. This one goes up as compared to this one. This is not called as diluted earning per share. This is called as anti-dilutive. This is called as anti-dilutive. This is called as anti-dilutive. And whenever the EPS is anti-dilutive, that is not considered for computing the EPS. Okay, means whenever the EPS increases instead of going down, that will not be DPS. So this will not be DPS. This will be DPS. DPS means dilution, means EPS has to go down. In case you find that the EPS is going up, that will not be DPS, that will become anti-dilutive. And in such a case, your basic earning per share will also become diluted earning per share. Okay, your basic earning per share will also become diluted earning per share. Shraddha is asking, sir, what if the tax rate changes in the year when it is paid to the debenture holders when they convert to equity shareholders? See, we are not looking at the future. We are looking at the current year only. In the current year, we are assuming that this conversion has taken place. We don't need to get into the future year. In the future year, definitely the tax rate will change. But that is not something we are required to consider. Rakesh is asking, sir, what we have to do with the debt of the company which has reduced by conversion to equity shares? If the debt has reduced, so we need to reduce the interest portion, and because of which this profit increases. Okay. Then I can see Pooja, Sandeep and Anita solved this. Great. Charu is asking, sir, most of the time there is reduction in EPS because use of debt gives tax benefit and EPS is more. If we reduce the debt, EPS will reduce. So if the EPS will reduce, then definitely it will be a situation of DPS. Vrinda is asking, but sir, if we assume this, in the current year, debenture holders will demand for interest. So I'm not saying that you will not pay them. I'm not asking you to change the P&L. I'm not asking you to structure this in the financial statements. It's only one of the disclosures you are giving. Please remember that the BPS is also computed wherein you are going by the same understanding that the debenture holders will get the interest. And the standard is nowhere stopping you from paying the interest. Please remember, standard is only creating a situation wherein you need to take the assumption, and after taking that assumption, compute this and give a disclosure. Clear? No recognition, no measurement is required to be changed. In fact, this standard doesn't talk about recognition and measurement. Okay, this is only about disclosures. Shraddha is clear on this. Great. Yes, any questions? Sanchita is asking, sir, how do we calculate post-tax interest? We'll see. We'll solve one illustration. Ria has also understood this. Okay, so I think we can now go to illustration number 5. Yeah, illustration number 5 we can pick. This is page 1.102. You can start solving this. Net profit for the current year is given. Number of equity shares outstanding during the year is given. And the basic earning per share is already computed for you. Okay. This is already computed for you. Number of 12% convertible debentures of ₹100 each are given. Each debenture is convertible into 10 equity shares. Okay. Interest expense for the year is given and tax relating to interest expense is also given. You are required to compute DPS. Start solving this quickly, please. Vrinda is asking, sir, we are assuming in the current year that conversion has taken place as the company makes provision for the future. Yes. Okay, now in this scenario, we have net profit that is 1 crore. And the number of equity shares is 50 lakhs. Yeah. Basic earning per share, even if the question could not have computed, I think it was very simple for us to compute. Now, what is the next thing that we are required to do? The next thing is to compute the adjusted profit. So now, to this, what do we add? Interest. Interest will be added back. Why? Because it will not be paid. Sorry, it will not be paid. So we will add interest. And on this interest, tax will have to be reduced. Less tax, 3,60,000. Yeah. So what do we get? 1,08,40,000 is the adjusted profit. So this is the adjusted profit. Correct? Number of equity shares we can see will also change. Each debenture holder will get 10 equity shares. So how many debentures do we have? 1 lakh. 1 lakh into 10. To this, add equity shares. Potential. 1 lakh into 10. So this becomes 60 lakh. Okay. So this is A, this is B. So now DPS, let's understand, is what? A divided by B. So what do we get? 1 crore 8 lakh 40,000 divided by 60 lakhs. This comes out to 1.81. Okay. In the question, basic earning per share is also given. Basic earning per share was ₹2. Now let's compare this to the basic earning per share. If we compare, what do we find? That this has gone down. This has gone down. In case this has gone down, what does it mean? That the EPS has got diluted. What does dilution means? Dilution means going down as compared to the basic EPS. So that's why our DPS will be what? 1.81. Clear? Clear on this? Our EPS therefore will be 1.81. Yeah, clear on this? Ria has computed this. Very good. Pooja has also computed this. Vinod is getting the same answer. Very good. Ria is asking, sir, when the data for 1 year is given, how do we know if the EPS is diluted or anti-dilutive? Because for checking whether EPS is dilutive or anti-dilutive, you don't need the data for 2 years. We need only the basic earning per share. Because when would it become dilutive? When it will be going down as compared to basic EPS. When it would be anti-dilutive, when it is going up as compared to basic earning per share. Clear? We are not comparing 2 years data. We are comparing the EPS of the current year. See, this is of the current year. This is for the same year. Yeah, I'm hoping there's no such confusion now. Tanu is clear on this. Ria is now clear. Kushi has computed this. Kushi is getting the same answer. Charu is asking, sir, if the tax to interest expense is not given in the question, how do we calculate? Okay, I think this is again very, very simple. Let's suppose if in the question amount is not given, currently the tax amount was given to you. Let's suppose amount is not given. Say this 3,60,000 is not available. Okay. You are only given the interest amount. And at times interest amount may also not be given. You may have to compute the interest amount. How do you compute interest? On the debentures, you will apply the tax interest rate and you will get the interest amount. In the question, at least the rate of tax they will have to give. The rate of tax has to come from the question. If the rate of tax is also not available, then you will have to assume that to be 0. In such a case, what will you do? You will consider this to be nil. In case tax rate is not given in the question. But let's suppose question says tax is 30%. Instead of amount, it says it's 30%. Now, how do you calculate tax? On this 12 lakh, you would have saved 30%. While computing your profits after tax, you would have saved 30%. Now what do? You will reduce 30% on this. Okay, so this becomes 3,60,000. In case it is 20%, it will be 240. In case it is 25%, it will be 3 lakhs. Clear? Clear charm on this? Vandana is asking, sir, 1 lakh, it is 10 lakhs. This one you are asking? Yes, this is 10 lakhs. And how do you get 10 lakhs? Every debenture holder is getting 10 equity shares. So that's why 1 lakh debentures into 10. These are the number of debentures into 10. 10 lakh. Okay. Clear on this? Vrinda is asking, sir, why is this tax deducted? Because we are looking at the amount which is net of tax. I think you need to go back to the basic understanding of EPS. For the purposes of EPS, which profit do we consider? Pre-tax or post-tax? It's post-tax. So that's why every number that will have to be considered in the numerator has to be post-tax. Yeah? Because that is the amount which is attributable to the equity shareholders. After paying tax, the residual amount will become attributable to the equity shareholders. Charu is now clear on this. What about others? Jay is clear. Sanchita is saying, sir, 70% of interest will be post-tax interest then. Yes, that's correct. Shivam is asking, sir, if the interest is not given and the rate of tax is given, then how do we find tax? I think this sort of question is of no use. You are creating a hypothetical situation. You are saying if the tax, if we are not able to compute interest, how do we compute tax? That will not be possible. Question will always give you the information to compute interest if the interest is not already computed. Because these type of hypothetical situations are not possible. Pratibha is clear, Vrinda is clear, Vandana is also clear on this, Sandeep is clear. Great. So with this, we come to an end to our discussion on AS20. And you should mark this illustration number 6 for your homework. Okay, so any questions that you may have on this, please let me know. Then we'll move on to the next accounting standard. AS24, discontinuing operations. Very simple and a small one. But before we get on to this, let's quickly discuss your queries in case you have. Okay, so you are all clear on this? Great. So what we can do is we can take a break now. Yeah. Pooja is asking for the break. Yes. So I think before we start with this new standard, we can take a break and let's meet after the break. So after the break, we'll start with this new accounting standard. AS24. Yeah. In the meantime, if you have got any queries which are not resolved, please send across. Okay. Hi, welcome back. So we'll now start with this new topic AS24. As we discussed, it's a small topic, and once again this topic is all about the presentation and the disclosure requirements. Means once again we are not going to talk about any recognition or measurement requirements as part of this standard. This standard is all about the discontinuing operations. So let us first of all understand what do you mean by discontinuing operation. Discontinuing operation, in simple terms, you can say, is an operation of an entity which is getting discontinued. When the entity has got a plan, means there should be a concrete plan to dispose of its business. Plan to dispose of. Plan to dispose of. Separate major line of business. And when you say separate major line of business, means the line of business which can be distinguished operationally and for financial reporting purposes. So what does it mean? Say a company has got two plants, plant A, plant B. Company has been maintaining separate books of accounts for both the plants, and for the purposes of year end, company consolidates these two. Yeah, as at the year end, what does the company do? Company consolidates these two, and that is how the financial statements of the company are drawn. So a separate trial balance is available for this as well as this. Means the data for both the plants are separately available in terms of the financial numbers. Yeah. These two plants, or you can say these two lines of business, are separately identified. Means they have their own P&L, they have their own assets, liabilities identified. Both of them are major lines of business for this company. And now the company finds this plant to be making losses for a long period of time, and that's why company plans to dispose it of. This plant has been running into losses, so the company's plan is to dispose it of. Okay. Now, because this plant is still running, the company has not shut this plant. This plant is still running, even though this has been making losses. And because the company has a plan to discontinue, to dispose it of, that's why this operation of the company will become discontinuing operation. This operation of the company will become discontinuing operation. Yeah. So you can say this will become discontinuing operation. And the other line of business with which the company plans to continue, company doesn't plan to dispose it off, will be called as continuing operation. This will be called as continuing operation. Okay? Yeah. Now in this case, couple of things become important for us to understand. That the company is not closing down or the company is not planning to shut down. Company will still continue, the entity will still continue, but a part of the entity, a major business line of the entity is planned to be discontinued. Now this may either be already discontinued or the plan could be that this will be subsequently discontinued, and that's why it may become discontinuing operation. Yeah. As regards this discontinuing operation, there are certain criteria which are required to be considered by us. Only when those criteria are met, we can say an operation will become discontinuing operation, otherwise not. Now let's look at those activities or the criteria. The plan of the management should be clear. Means this plan should be concrete plan. It should not be a thought, it should not be an idea, but it should be internally approved. Means the board approval should be there in case of a company. In case it's not a company, then the required approvals of the approving authority should be there. Means the management should be firm in terms of its plan to dispose it of. Secondly, when the plan is to dispose it of, an active market search should have started for the potential buyer. Means this plan should not be only limited to the internal plans which are planned and finalized and then no action is taken. No, the company should be, the management should be actively engaged, actively involved in phasing it out, in completing this discontinuation. And how will that be completed? By finding a potential buyer. Yeah. So all of these activities should be reflected on the part of the management to be called as, for this to be called as a discontinuing operation. There are also some examples which are given. You can refer to this page number 1.117. Yeah. Examples of activities that do not necessarily satisfy criteria A of the definition, means the discontinuing operation, but that might do so in combination with other circumstances include. Let's look at those examples. Gradual or evolutionary phasing out of a product line or class of service. So this may also become discontinuing operation. Discontinuing, even if relatively abruptly, several products with an ongoing line of business. Shifting of some production or marketing activities for a particular line of business from one location to another. And closure of a facility to achieve productivity improvements or other cost saving. Yeah, so all of these will also become your examples of discontinuing operation. Okay. Now, as regards the discontinuing operations, this standard requires disclosure to be given in the financial statements. Before I get on to the disclosure, I'm sure many of you who would have dealt with the financial statements of a company, during the course of your working must have seen that while preparing the P&L, generally two parts are given. Let's understand how is that given. When it comes to statement of P&L, if you look at the financial statements of a company which will have some discontinuing operation, generally this is how you will see the P&L. So first of all, revenue is given. Yeah, then the expenses, then the profit. Okay. This profit is from continuing operations. This is how companies show this. Okay, this is also, you can say, part A. Then the companies would show profit or loss from discontinuing operations. Which becomes part B. Okay, with similar sort of breakup. Revenue separately for this, expenses separately for this, and the summation of these two means the profit or loss for the company as a whole then becomes A plus B. This is how Schedule 3 also requires you to present, wherein separate presentation, can you see? Separate presentation is given in respect of numbers for discontinuing operations. Why? So that the users are able to understand that out of the financial numbers which they are looking at, whether it is about balance sheet or it is about P&L or some other part of the financial statements, what is the part which belongs to the discontinuing operations. Okay, so this is one of the presentation requirements. Other than this, there are also certain disclosure requirements. Disclosure requirement means something which will form part of notes to accounts. Let's understand those disclosure requirements. First thing is to give the initial disclosure event. Now, what is this initial disclosure event? Means when the company is firm, when the company has decided, when the company has come up with a plan for which everything is finalized in terms of disposing of a line of business which will meet the criteria of a discontinued operation, a disclosure will be given about this event which is going to take place. This event has not taken place. This will take place in future. Correct? This event will take place in future. Currently, it's only a plan, but the disposal is not yet done. The operation is not yet discontinued. This will be discontinued in future. So this initial disclosure event is required to be disclosed in the financial statements. Yeah, for which the standard says it will occur. This event will occur for which the company should have either of the things. Either the entity should have binding sale agreement, or the board of directors or the approving authority in case of a known company should have a clear-cut plan which is approved by them and which has also been announced. Correct? Now, this disclosure event is also required to be disclosed in the financial statements in the notes to accounts. Okay. Now, what are the disclosure requirements? What are going to be those disclosures which you will give in the notes to accounts? Let's understand. First, description of the discontinuing operation. So, in the notes to accounts, a note will come wherein we will explain this event. We will describe this event. So, plant A, which is planned to be shut down. Yeah, so company will describe this complete plan of its. Okay. Second, date when this disposal is expected to be completed. Third, amount which is involved. Amount which is involved means if the sale has to take place and if the agreement has been finalized, then the company will also include the numbers that the agreement has been finalized with the potential buyer or with the buyer which may be there in place for this much amount, and the carrying amount of the assets or the liabilities or the net assets which are going to be disposed of is what? Yeah, all of those amounts will have to be disclosed over here. The amount of revenues and expenses which are going to be impacted, and this will also have linkage to the statement of P&L, because in the P&L, as we saw, there was a separate presentation of profit or loss which was getting generated from discontinued operation. And here again, I'll repeat this. Some of you may be thinking, but sir, when the plan is to dispose it off, why will the revenues get generated? Why the expenses will be incurred? Please remember, the plant is not yet shut down. The plan is to shut it, or maybe the plant will continue to run and this running plant will be sold. So till the time it is not sold, whatever revenues are generated, whatever expenses are incurred, whether it is resulting into some profit or the losses, will all be attributable to whom? The entity only. Yeah. So that's why this will come. Okay. Next, amount of net cash flows. Now, in respect of this particular operation, which is planned to be disposed of, the net cash flows which are attributable to this. Okay. So balance sheet numbers, P&L numbers, cash flows, all of those are required to be disclosed. So you can say in simple terms, a detailed description of this entire event has to be brought out in the notes to accounts. Clear? Clear? Some disclosures which are other than the initial disclosure note is about the presentation which is required to be given in the financial statements. Next, now even though this activity of discontinuing the operation is generally expected to be completed within 1 year, generally. It is generally expected to be completed within 1 year. So say on 31st March 2021, such an event was planned. Okay, so there was such an event. Generally, what will you find? By next financial year, this event will get completed. Generally, this sale would take place within 1 year. This is generally assumed. However, it may be possible that this event hasn't got completed even on this day. Okay, so if there was a discontinuing operation, that continues to remain even on this date. Ideally, this discontinued operation should not remain. It should get sold off. Yeah. So this will not be there in the next year or by the end of the next year. But at times, it is possible that it continues to be there. In such a case, what will be required to be done? The notes to accounts means the disclosures which were given as part of financial statements of this year will have to be updated in the next year's financial statements. So these notes will have to be updated. Now, what are going to be the updates? First, of course, the description will continue, and along with that description, the progress of this sale or the progress as to how the company plans to achieve this sale or this disposal has been done during the year will have to be explained. The number 2 is the impact on the financial statements. Impact in terms of the amounts which are involved. So the amounts would not have remained same, they would have changed. So all of those revised amounts will also be required to be updated over here along with the comparatives. Clear? Clear? Yeah? In case the company is giving interim report, for example, the company is a listed company. Okay, it's a listed company. So every quarter, company has to come up with the results. Or say the company comes up with the set of financial statements, which may be interim or which may be completed, depending on the plan of the management. There again, the updates on this disclosure are required to be given. Because it's an important event, so that's why it is very, very important for the users of the financial statements to know as to what all has been happening as around this event, whether this has got completed or not. If this has not got completed, what is the impact and what is the continuing impact which the company plans to have? What is the progress which the company has made so far in terms of executing this? Yeah, so all of these disclosures are required to be given. Clear? Clear on this? Any questions? Any doubts? Charu is asking for the doubts of the previous AS. Sure, Charu, will take those doubts. Currently, in case you have got any questions, any doubts on this topic, please let me know. Yes, quickly. Any questions, any doubts? Because we are done with this topic. As I told you, it's a very small topic and it only deals with the presentation or the disclosure requirements. So that's it that we had in this standard. So any questions, any doubts that you have on this, please let me know. Okay, Pooja is clear on this. Great. Then I think Harsh is asking about interim reporting. Interim reporting will say the reporting which is done before the financial year end. For example, a listed company is required to report its financial numbers every quarter. That is called as interim reporting. Sometimes a company voluntarily may do interim reporting, or it may be required to do interim reporting for certain purposes. Say, for example, company wants to go in for IPO. Company will have to prepare its financial statements for less than a year. That is called as interim financial reporting. Okay. Any more questions? With that, these are the type of questions you can expect on this. Yeah, because this topic is all about the disclosures. So that's why you don't get into too much complexity in terms of getting into the numbers, computing the amounts. There's recognition, measurement, all sort of things are not there. So I think we can now move to the next accounting standard, AS 18. Let me just see in case you have any further questions. Otherwise, we'll start the next topic. So you're all done? Great. A related party. Once again, in this standard, we will not be covering any recognition and measurement requirements. Okay, once again, this standard once again is all about disclosures only. We are not going to discuss anything related to presentation. It's all about disclosures. Only and only disclosures have been discussed in this standard. But this standard is very important, not only theoretically but practically also. In fact, the topic is very important because the related party is something on which almost every law, every act you check, some guidance is available. When you go to income tax, when you go to indirect tax, when you go to accounting, when you go to auditing standard, everywhere, some guidance has been provided on the related party or the disclosures around related party or the transactions with the related parties. So that's why this topic is very, very important. So now, in simple terms, what do you mean by a related party? In very, very simple terms, if we have to understand about a related party, we can say a party whom we can influence or through whom we can get influenced. Means if there is a party which is able to influence us or which can get influenced by us, that will become a related party. Okay, in very, very simple terms. For example, parent and subsidiary. Parent and subsidiary. Or you can say holding company and the subsidiary company. Let's suppose there's a company which has got control over another company. Parent company which has got control over another company. So this is H Limited and this is S Limited. And how is this control established? Let's suppose H Limited holds 90% shares of S Limited. H Limited holds 90% shares of S Limited. Okay, this makes them holding and subsidiary. Yeah. Now in this case, certain problems may arise. Let's try to understand about the problem. Because these two companies are related to each other in a way. Okay, we don't know about the meaning of related. I'm saying because they are in a way related to each other. Why? Because one company has got investment in another company, and this investment is significant investment. That's why it is possible that if they are making transactions with each other, those transactions may not be taking place at the market price. Say for example, holding company is selling goods. Holding company is selling goods to the subsidiary company. Yeah. And the goods which are sold are below market price. Or the goods which are sold are above market price. When such a situation arises, wherein the transaction is not taking place at the market price, okay, that is also called as the transaction is not taking place at arm's length. Arm's length means market price. Now, let's suppose such transactions are taking place, okay, wherein one company is selling to another company at below market price or above market price. Can you tell me what could be the impact because of this? Can you tell me what could be the impact because of this? Do you see any impact because of this? Quickly, huh? If the companies are carrying out transactions at below market price or above market price, what could be the impact? Yes, quickly, over to you. What are your thoughts? Quickly, I'm waiting for a response. Pooja is saying, yes, sir, we do it in company law. Great. As I told you, related parties is something which has been discussed everywhere. Yes, quickly. What are your thoughts? Now, what could be the impact? Or do you see any impact because of these type of transactions? Quickly, any thoughts from you? Vinod is saying one company is making more profit, other company is making less profit. Okay. So how does it impact us? Riya is saying profit will get impacted. Charu is saying a person may be getting commission also. Sanchita is saying one entity is showing more losses. Now it is evident that if the transaction is not taking place at the market price, at the arm's length, so the profits of the company are getting impacted. Yes or no? Yes or no? In such a case, profits of the company are getting impacted or maybe getting impacted. We don't know. This standard doesn't say anywhere that the companies which are related to each other or the related parties need to carry out transaction at arm's length. This standard doesn't talk about the nature of the transaction, means in terms of estimate. Now, how would it help? The users of the financial statements would get to know that in the financial statements of the company, what are those related party transactions? What is the nature of those related party transactions? And what impact may have on the total financial statements or the complete set of financial statements, or what is the proportion of the transactions with the related parties as compared to the total transactions of the entity. Yeah, the user will be better aware, the user will be able to better understand the financial statements if such disclosure will be made available, irrespective of the fact whether the transaction is taking place below market price, above market price, or at the market price. Okay, but please remember, this standard doesn't require anywhere the transaction to be taking place at market price. Means we are not saying the standard is not asking, or the standard says no, you can just make the transaction at below market price. This standard, this requirement doesn't come from the standard. Standard only requires the disclosures to be given. Yeah. And what is the importance? Importance is to make the users aware of the nature as well as the amount involved as well as the proportion of the transactions with the related parties. Now, we have understood the importance of this standard. Now we need to understand about the related parties first of all. Because till the time we are not aware of the related parties, we will not be able to give the disclosure. Yes, so the next step is what? To know about the related parties, means which all parties will be considered as related parties. So this standard deals with 5 types of related party relationships. Five types of related party relationships. First, entities that directly or indirectly through one or more subsidiaries or through one or more intermediaries control or are controlled by or are under the common control with the reporting enterprise. Say there is a company H Limited which controls S Limited. So this is holding, this is subsidiary. So they will become related parties. Let's suppose H Limited holds 100% shares of S Limited and S Limited holds 90% shares of B Limited. In this case, these two are holding subsidiary. These two are holding subsidiary. Okay. These two are related to each other. These two are related to each other. And indirectly, H is also the holding company of B. Indirectly, H is also the holding company of B Limited. Correct? So that's why S will become intermediate. Or S will also be called as immediate holding company of B. S will also be called as immediate holding company of B. H will be called as ultimate holding company of B. And H will also be called as holding company of S. And in this case, all of these parties will become related to each other. H is related to S, H is also related to B, S is related to B. All of them are related to each other. Why? Because one of the entities is controlling the other one, whether it is direct or it is indirect. Clear? Let's suppose we have another type of situation wherein H has got 100% investment in S and H has another investment of say 80% in S2 Limited. In this case, again the relationship is same between H and S2, but if you look at S and S2, who are they? They are fellow subsidiaries. They are fellow subsidiaries. They are fellow subsidiaries, and fellow subsidiaries are also considered as related parties as per AS 18. Clear? Clear on this? So this is relationship type A. This is relationship type A. Clear? Ria, you are clear on this now? Okay, now let's move on to relationship type B. Associate and joint ventures of the reporting entity. Now what does it mean? Say there is an investor, investor 1, and there is another investor, investor 2. Okay, there are two investors. Both of them have formed a joint venture, JV Limited. There is a company which they have formed, JV Limited, joint venture. It's a joint venture wherein I1 holds 50%, I2 holds 50% shares. 50% shares are held by I1, 50% shares are held by I2. In this case, both the investors have got control over JV Limited. Or you can say they have got joint control over JV Limited. If you look at these two investors, if you look at these two investors, they are not related to each other. They are not related to each other. They may be unrelated parties who have come together to form a joint venture. They may be unrelated parties who have come together to form a joint venture, which is this company. But these two are related to each other. And these two are related to each other. Okay? These two are related to each other and these two are related to each other. Clear on this? Yeah? I1 and JV are related, I2 and JV are related, but I1 and I2 are not related. Clear? And why are they related? Because I2 and I1 have got joint control. They have got joint control over JV Limited. Yeah? Within B, another type of situation is possible. Let's understand that. And that is between the company, or you can say the investor. So there is investor I Limited, which holds 30% shares of A Limited. I is an investor which holds 30% shares of A Limited. Yeah. By holding 30% shares of A Limited, what do you see? I has got significant influence. I has got significant influence over A. I has got significant influence over A. What do you mean by significant influence? See, when it comes to control, control means an entity will be able to direct the decision making of another entity. For example, when we talked about H and S, wherein H was having control over S, H had the power to direct the decision making of S. Means if any decision is required to be made in respect of S, whose approval will be required? Approval of H. Who is having the power to take decisions in respect of S? It is H. That is called as control. This situation is called as control. Now this control could be unilateral control or joint control. Something we saw in case of JV. I1 and I2 both were having joint control. But let's suppose if the control is missing. Now in this case there is no control of I over A. Okay. Control is missing. Control is missing. Why? Because let's suppose H has got 70% shares of A. H has got 70% shares of A. So who has got control over A? It is H. So H has got control over A. But 30% shares of A are held by whom? I. So now because of these 30% shares, I will get some voting power. I will also get some voting power. I may not be able to direct the decisions, but whenever the decision making will be done, whenever the board meeting will take place, I will be there to participate. I will be there to participate. So I doesn't have the power to take decisions, but I has got power to participate in the decision making. Of A. Eventually the decisions may be taken the way H requires. Eventually the decision may be taken which I doesn't want. Okay. But still this power to participate is there. He can be there in the meetings. He will be attending the meetings. He will be participating. He will be saying something. Whether his say is acceptable or not, it's a secondary thing. Clear? Clear on this? Clear on this part? Yeah? This type of situation is called as significant influence, and whenever an investor has got significant influence over a company, then the investee, who is the investee? A Limited, becomes associate. This becomes associate. Or you can say this is called as associate company. And this is the investor company. Clear? Investor company and associate are also related to each other. H and A are also related to each other. Why? Because H has got control over it. As per point number A. Now we are on point number B. In case of point number B, what did we find? That I and A are also related to each other. But please remember, H and I are not related parties. We are not saying that H and I become related to each other. Okay, we are only talking about I and A and H and A. Clear on this? Clear on this? Okay, now moving on to situation number C. Moving on to situation number C. It says, individuals owning directly or indirectly an interest in the voting power of reporting enterprise that gives them control or significant influence and the relatives of any such individual. Now, let's understand what do we mean. So far, whenever we talked about the reporting enterprise, who is the reporting enterprise? S. Means for S, we are going to check who all are the related parties. So, in point number A, what did we find? That H Limited was the related party. Correct? In point number B, we found I1 Limited and I2 Limited are the related parties of S, because we were checking the related parties of S, correct? And we also found that H may also be related party of S in case S is associate of H, correct? Everywhere when we were talking about the investors, we were talking about the companies. Everywhere the investor was a company, but it's not necessary that the investor has to be a company. For example, let's suppose if we take RIA here. Okay, yeah. Let's suppose RIA holds 70% shares of S Limited. In this case, RIA and S Limited will become the related parties. Why? Because RIA has got control over S Limited. So now we are not looking at the company, but we are looking at the individual. Yeah, through individual also related party relationships are possible. Let's suppose if we talk about Tanu. Okay, Tanu has got, let's suppose, 30% shares of S Limited. Now, Tanu is an individual who has got significant influence over S Limited. So now individual will also get covered. Yeah. Further it says the relatives of the individual will also be covered. So Tanu and the relatives of Tanu. Similarly, RIA and the relatives of RIA. So RIA was having 70%. Yeah. So now the relatives of RIA will also be covered as the related parties. Now, who all will be the relatives of RIA and Tanu as per the accounting standard will have to be considered. Yeah, whether it's going to be father, mother, brother, sister, all of these will understand in some time, not now. Yeah, but important thing is that these relationships are not only required to be considered from the perspective that the investor is a company or an entity. The investor could also be an individual, wherein that individual will also become related to this reporting entity. This is the reporting entity. Why are we saying reporting entity? Because we are preparing the financial statements of S Limited. And while preparing the financial statements of S Limited, we need to check who all are related to S Limited. So that's why we are calling this as the reporting entity. Clear? Clear? Clear on these three types of relationships? Yeah. So let me just get on to your queries now. Tanu is saying, what is substantial interest? Substantial interest means significant interest. Kunal is asking, is there a minimum percentage investment criteria in order to have a significant influence? Yes, it has to be 20%. Charu is asking, significant influence is defined by any percentage. I mean, how to recognize this control or significant influence? See, control will only come when the percentage is more than 50. Yeah, and significant influence will be a situation which is less than 50 and greater than 20. Greater than 20, less than 50. Yeah. Khushi is asking, who will be the relatives of individuals? So this part is yet to be covered. We'll cover that separately. Who all relatives of individuals will be covered? We'll cover that part separately. Okay. As of now, you can say this is to be covered. I have not yet discussed. For the time being, you just need to simply remember that individuals will get covered, and whenever the individual will become related party, so the relatives of individual will also become the related parties of S. Okay, relatives of Tanu, relatives of Ria will become related parties of S. Now, who all relatives will get covered, we'll talk about separately. Okay, clear? So now with this, I think we need to conclude our discussion for today because we are just running out of time. We are not yet done with this standard. There's still a significant part of this standard which is yet to be covered. So we'll cover that part in the next session. Plus, I also understand some of your queries, like Charu mentioned, are related to the other topics. We'll cover that also in the next session. Okay. Yeah, clear? Vrinda has a queries. Vrinda is asking, sir, then the individual and relatives will be related parties? Yes. Individuals and the relatives will be related parties of S Limited. Related to S Limited. Because relative is already related to Tanu. There is no doubt about it. Now we are saying this relative of Tanu will also become related party of S Limited. Clear? Okay, Pooja is saying, yes, sir, we have understood this in law also. Now it becomes easy. Very good. That's great. And one homework for all of you is to revise this part. Revise part of AS 18 covered today. Please remember, there are certain examples we will discuss in the next session. Plus, some of these relationships that we have discussed today, we are going to pick those relationships in the next session. So that's why it's very, very important that when we meet next, you come after revising all of these. Otherwise, it may become very difficult for you to appreciate some of the part. Okay? Yeah? So thanks to all of you once again for your time today and for your wonderful participation. Thanks so much. We'll meet in the next session. We'll cover some of your queries related to other topics and we'll also wrap it up and we'll start with a new topic in the next session. Thanks so much. Yes, thanks.